Welcome to the latest edition of Fundamentals. This time around, I'm going to look at a passively managed member of our list of 72 favourite funds, namely Vanguard UK Inflation-Linked Gilt Index Fund. Now, Vanguard's one of the largest investment companies in the world with a long history of managing passive strategies, and this fund is a tracker. There's no fund manager here, just a programme that ensures the fund provides the performance of the underlying assets as closely as possible, minus its running costs. This fund tracks the Barclays UK Government Index-Linked Float-Adjusted Bond Index. It focuses on bonds that trade freely in the market and come with maturities greater than 1 year. Most importantly, as the name suggests, the bonds are index-linked. Known as linkers, these traded debt instruments have both their principal, the amount you get back when the bonds mature, and their coupons, the interest rate you get during the life of the bonds. They're both adjusted according to inflation. More specifically, they're adjusted to the Retail Price Index, or RPI inflation, not the more popular or more widely known Consumer Price Index, or CPI. The good news, therefore, is the value of the coupons you get increases if inflation increases. The bad news, therefore, is a drop in the rate of inflation, or even deflation, could see the value of the gilts fall and their coupons diminish. This chart here shows that the UK has only seen prices fall according to the RPI just once since records began in 1949, and that was in 2009, right at the end of the financial crisis. Over the last 68 years, RPI inflation in the UK has averaged 5.4%, and since 1990 it's averaged 3.1%. The tracker provides exposure to a basket of 28 different UK government index-linked gilts. As we can see here, the vast majorities of the linkers have got a coupon of between 0 and 4%, although the yield to maturity will potentially differ from that depending on the performance of the underlying bonds. Remember that just like a share, the higher the bond price goes, the lower the yield on a bond, and vice versa. The linkers are all AA rated, as that's the UK government's credit rating, while the average maturity of the bonds in the portfolio is long. This graphic shows the range of maturity by years, and the effective maturity is nearly 24 years, while effective duration is just over 22. Vanguard is a massive fund manager, and its economies of scale means that it can run its funds cost effectively. That's reflected in a lowly 0.15% ongoing charge for this tracker fund. Note that we are talking about the fund's accumulation units, so it will automatically reinvest any coupons from the underlying gilts for you. Vanguard UK Inflation-Linked Gilt Index Fund is eligible for SIPPs, ISAs and dealing accounts, and the initial minimum investment is just 1 share. As a final point, please note that the units in the fund currently sell for around £184 each. So, those are the mechanics. The question to address next is why could investors consider this fund for portfolio inclusion today? The major reason is clearly inflation. If you think inflation is coming, then index-linked gilts are one way to protect yourself and the value of your money, as the coupons on the gilts and therefore the fund will rise in line with RPI inflation. And as we can see here, inflation has crept higher over the past 12 months or so. If you think we're really on the verge of a globally synchronised recovery, that low unemployment is about to spark wage growth, banks are about to start lending, and that central banks have left interest rates too low for too long, then this may be one way to protect your money and its real inflation-adjusted value. But that's not to say that the Vanguard UK Inflation-Linked Gilt Index Fund will suit every investor. After all, you may take the view that inflation is not going to gallop higher or even stay elevated. You may feel that weakness in the pound and strength in oil explains 2017's increase in inflation, which you may see therefore as a temporary surge rather than something more profound. After all, global indebtedness, weak demographics in the West, which means fewer people of working age and more of pensionable age, and the internet are all powerful deflationary forces. If this is the angle that you're taking, then you may feel index-linked gilts and a tracker fund that follows them is an insurance policy you may not need, especially as this fund has already done well, so if inflation eases or even gives way to deflation, no matter how unlikely that may seem now, then the underlying gilts and therefore the tracker could do less well or even fall in value. What this does go to show is that investors must therefore do their research on Vanguard UK Inflation-Linked Gilt Index Fund to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.